Another kind of receivable in this chapter is notes receivable. This is basically borrowing money. Well, it can take place and it can arise from a few different types of scenarios, but they're kind of like accounts receivable. Somebody owes you money, but these things come with interest, and they come with a promissory note where both parties are identified on the note. There's an amount, a face amount. There's a length of time. When's it due? A maturity date. Um, an interest rate. The maker of the note signs it. So there are components to a note that make it more substantial, I guess, than accounts receivable. Um, some topics relating to notes. Determine the maturity date. You just read through that. Computing interest. So notes come with interest. So you have to be able to compute interest income over time as you hold the note. So here's the formula for calculating interest. It's just the face amount of the note times the annual interest rate. And anytime you see a percentage rate, it's going to be an annual rate. So when you multiply a face amount of the note by a percentage rate, you're going to get an annual amount of interest. But most of the time, you're not trying to compute an annual amount. You need some fraction of a year. So then you multiply your answer here by some fraction. Typically, we talk about a year in terms of months. So if 2 months went by, 2 months of time went by where you held this note, and you want to compute 2 months of interest, you'd multiply this result by 2/12, or divide by 12 to get a monthly amount, and then times 2. So it's the same as multiplying by 2/12, and that gets you the amount of interest that you're looking for. Different ways to express or calculate interest depending on the time factor that the terms of the note are discussing. Sometimes you'll see a note written in days, months, or year, so you calculate interest based on that terminology. We use a 360-day year for simplicity when notes are expressed in terms of days. Recognizing notes receivable. The book only gives you one example here, but there are 3 ways that notes receivable can come to exist. All 3 ways have notes receivable being debited. They all are resulting in you being owed, or the company being owed money by somebody else. In this example, we already had sold some stuff or whatever to Brent Company, but they couldn't pay us as a normal account receivable, so they probably contacted us to say, hey, can I pay you over a longer period of time, and I'll give you some interest too. So in this case, you replace the accounts receivable with a note receivable. Credit away the AR, debit notes receivable. Another example would be if you could make a typical sale. You sell something to a customer, but they want to pay you over a longer period of time. You could credit sales and debit notes receivable instead of accounts receivable to show that you're collecting that cash over a longer period of time. And then finally, you could lend money to somebody. That would be crediting cash and debiting notes receivable. So you make this note, you debit notes receivable, and then you have to be able to record the collecting of the note receivable when it comes due. All right, that's called honoring notes receivable. So what basically happens then is you get paid, debit is to cash, note receivable will go away, so you credit notes receivable, but you're going to have to record some interest revenue that you earned while that note was outstanding, because you're going to get more cash than you were owed. All right, and the difference is interest. So you have to be able to calculate the interest, and here in this example, they calculate interest like this to figure out 375 as the interest amount. So that's the amount of interest revenue that they record. I'll continue on the next slide.